สวัสดีค่ะสวัสดีค่ะแขกผู้มีเกียรติทุกท่านนะคะขอต้อนรับทุกท่านค่ะเข้าสู่หลักสูตรอบรม Common Issues in Early Stage Fundraising นะคะและขอบคุณทุกท่านอีกครั้งค่ะที่สละเวลาเข้าร่วมโครงการอบรมในครั้งนี้ค่ะในครั้งที่3นี้นะคะเราจะมาคุยกันในหัวข้อ Exit Strategy ค่ะโครงการอบรมในครั้งนี้นะคะเกิดขึ้นจากความร่วมมือระหว่างตลาดหลักทรัพย์แห่งประเทศไทยโดยห้องเรียนผู้ประกอบการนะคะและ Expara Thailand ภายใต้โครงการการรับมือและฟื้นฟูธุรกิจอย่างเร่งด่วนซึ่งดำเนินการโดย Youth Business International และได้รับการสนับสนุนจาก google.org ค่ะโครงการในครั้งนี้นะคะจะดำเนินการอบรมให้ความรู้ผู้ประกอบการไทยอย่างต่อเนื่องจนถึงเดือนเมษายนนี้ค่ะในวันนี้นะคะเราจะใช้เวลากับคุณดักลาสประมาณ1ชั่วโมงนะคะที่จะมาคุยกันถึงว่าexit strategy นี่นะคะมันสำหรับคุณดักลาสแล้วมันสำคัญยังไงนะคะและก็เราได้มีการรวบรวมคำถามที่ทุกท่านได้ส่งเข้ามาในระหว่างลงทะเบียนวันนี้ก็จะให้คุณดักลาสใช้เวลาเต็มๆนะคะตอบคำถามทุกท่านเลยเพื่อไม่ให้เป็นการเสียเวลานะคะในลำดับถัดไปค่ะดิฉันอยากจะขออนุญาตเรียนเชิญทุกท่านพบกับคุณดักลาสนะคะ Founder and CEO of Expara ค่ะ Douglas, if you're ready, please kindly turn on your camera and the next hour is yours.
Okay, thanks so much, Nan, and good evening. Welcome, attendees, and nice to see you all here on this Wednesday evening. Tonight's topic, exit strategy. Why does it matter? This is one of my favorite topics, exit strategy, because I believe that this is one of the least understood or most misunderstood aspects of startup fundraising strategy. And it's, I think, in some ways, the most important component of the startup fundraising strategy gets the least attention, in my experience, from startups. And sad to say, especially Thai startups, I see very few Thai startups that have thought carefully about their exit strategy at the point where we meet them. And I'm going to try to help to correct some of the misunderstandings about exit strategy tonight, and also explain why I feel exit strategy is so important and why it should definitely not be overlooked. I think I can see in the last talk that I did in this series, which was on valuation. It was hugely, way over attended, and then because everybody thinks about valuation, especially entrepreneurs, I think way over focus on valuation. Of course, valuation is important, but it's only one part of the fundraising strategy. And today I'm glad to see attendees we have tonight, but clearly. Valuation very sexy, and exit strategy apparently much less sexy, but actually as or more important than ultimately than valuation. I think everybody's familiar with my background, so I don't have to spend a lot of time on this, but basically I'm doing venture capital in Southeast Asia for the last 21 years in Singapore, Thailand, Vietnam, Malaysia, and Hong Kong. And in Thailand, I've been teaching for also 20 years in Singapore and in Thailand, in Sasin and National University of Singapore. And also I'm visiting professor in RMIT and Hong Kong University and Assumption University. So I have had a great opportunity to combine venture capital investment career with a teaching, training, mentoring career. And I try to spend as much time as I can sharing what I hope that I've learned through my experience in startup and venture capital with entrepreneurs and investors who are interested to better understand the business that we're in. I think it's a very difficult business to succeed, and the more we know, the better we understand, the better our chances of success. So why is exit strategy so important? To answer that question, let's ask another question. And this question is, how do VCs make money? How does any equity investor in a startup make money? If you're a VC, if you're an angel investor, if you're a CVC, if you're a founder, also making money from the shares that you hold in your company, everybody's making money the same way. They're making money through either a trade sale where the company that you invested in, so let's say I'm a VC, I invested in your startup, I make money when I have a chance to sell my shares during a trade sale, which is when your company is purchased whole by another company, usually a much larger company in the same space as you or an adjacent space or looking to enter your space, or in an IPO. So initial public offering, which of course we're at the home of IPO in Thailand and at one of the, if not the preeminent stock exchange in all of Southeast Asia, which is Stock Exchange of Thailand, who's our gracious partner tonight. So everybody understands about IPO. And in an IPO, we get to sell our shares through listing our company on a public exchange, and then we can sell our shares in secondary sales to investors on the other side of the trade in the stock market. So those are the two what are called exits for VCs, angel investors, or CVCs. Okay, so if these two exits are the way that VCs make money, then if there is no exit, there is no ROI, meaning no return. So if the company does not exit, the VC makes zero. And in fact, 75% on average of venture capital investments end in the VC making either zero or less than one time their investment. And the vast majority of those, there was no exit, meaning the company did not list or go to a trade sale. So no exit means no return. Second reason, second consequence of VCs make money through exit. If there is no exit strategy, then the valuation that you have for your startup is meaningless, because valuation is driven by exit strategy. And these are the two fundamental reasons why I say exit strategy is so important, and why lack of exit strategy or misunderstanding of exit strategy is a terrible problem in fundraising. You know, think about it this way. You're pitching to an investor to raise money for your company. When you don't have an exit strategy, what you're saying with your pitch is, please invest in my company. I'm going to guarantee no return for you. Or I have no idea how to guarantee a return for you. I have no plan or strategy to generate a return for you. And by the way, the price that I'm giving you for this investment is meaningless because it's not in any way related to a return for you. So that's what obviously nobody ever says that, and nobody means to say that, and nobody means that through lack of an exit strategy. But in fact, that's exactly what you're saying to investors. So for those of you that attended the valuation talk last week, I have to reprise a little bit of what I talked about in valuation last week, because you saw the second reason on the previous slide why exit strategy is so important is because of the relationship between exit strategy and valuation, which I did talk about in detail last week, last time. But for those of us who weren't there, I need to quickly summarize. So if we want to calculate the return on investment for a VC, we only need two numbers: exit valuation divided by current valuation. So if you think about, now this is a little oversimplified because we still have to adjust for dilution, which is not very important for our discussion tonight because it doesn't change the overall relationship between the numbers. It just changes the scale of the numbers. So return on investment equals exit valuation divided by current valuation. Exit valuation is determined by your exit strategy. Without an exit strategy, therefore, current valuation is meaningless. Because you look at that first formula, the investor's return is determined by exit valuation divided by current valuation. So you are proposing when everybody, when they're raising money, they have a current valuation. But in order for the investor to estimate or even to have any idea of what the return on this investment might be, they need to know the exit valuation, or at least the theoretical or possible exit valuation. Otherwise, the current valuation doesn't mean anything. So this is why I say no exit strategy means your valuation is meaningless. And okay, when I talk to entrepreneurs about this, I like to ask every entrepreneur in our first pitch meeting, said, what is your exit strategy? And I have a list. These are a list of my top 5 exit strategy fails, meaning top 5 failed answers to the question of what is your exit strategy. So the first response I get is, it's too early to think about exit. So if that's true, if it's too early to think about exit, but exit determines my return, then it's too early to think about investment. Because if you haven't thought about exit, you haven't thought about return. If you haven't thought about return, how can you possibly be raising money? So if it's too early to think about exit, it's too early to think about fundraising, and you shouldn't be in the investment pitch. Okay, second fail. Exit is sort of a variation on the first one. The first part is variation. Exit is so far in the future. How can we possibly know how we will exit at this point? Now, this is absolutely true. How can we possibly know how we will exit at this point in time? We don't know. Nobody knows. But this is true about every aspect of what's going to happen to your startup. How can we possibly know what your revenue is going to look like? How can we possibly know what your profitability is going to look like? How can we possibly know how fast your market is going to grow? We don't know anything about what's going to happen to your startup in the future. We can't know anything about that because it's in the future, and the future is unknowable. But I think this is the first misunderstanding. How can we possibly know how we will exit? I'm not asking, when I ask about your exit strategy, I'm not asking you to forecast and predict how you will exit. I want to know what's your strategy to exit. And we have, as an entrepreneur trying to build a successful company, you definitely have a strategy for many things that you don't know. You don't know what your sales are going to be like, but you have a sales strategy. You don't know what will be the results of your marketing campaign, but you have a marketing strategy. You don't know what the next version of your product is going to look like, but you have a product strategy. So exit strategy is not a prediction about how you will exit. Exit strategy is, how do you plan to exit? So these are two very different things. And I think that's the first most common confusion. We're not asking how you'll exit. How are you planning to exit? Okay, third fail. We don't want to think about exit. We just want to build great products that customers love and a great company. Yes, of course. We also want you to build great products that customers love and build a great company, because this is how you achieve successful exit. Now, nobody achieves successful exit by developing an exit strategy. You achieve successful exit by building great products that customers love and a great company. But that doesn't mean you shouldn't think about exit. If all you want to do is build great products that customers love and build a great company, but you never want to think about exit, that's okay. But then you can't raise money. Then you have to fund yourself with your own money, or you have to borrow money and then pay it back, because lenders don't care about exit. If you want to bring in equity partners who make money through exit, you have to think about exit from the minute that you start to talk to them. So, okay, just want to build and don't think about exit, fine. But again, then you shouldn't be raising money for this company. Fourth fail. We don't want to exit. We're in this to build a successful company for the long term. Again, exit strategy is not for you, it's for me. It's for the investors. If you personally don't want to exit, that's fine. You can keep if you want to keep your shares forever, well, okay, that's not exactly fine, because in a trade sale, you might have to sell all your shares, but, and of course you should sell all your shares if you're in a trade sale. But I think what entrepreneurs usually mean when they say this, they don't want to exit the business. They want to keep growing this company as long as it's possible and as long as they enjoy it, which they will do after the exit. Bill Gates provided exit for Microsoft investors like 30, 40 years ago. So did Steve Jobs. So did Mark Zuckerberg. So did every other successful entrepreneur that you know. They all provided their investors with an exit, and some of them are still running their company. Now, even in trade sales, entrepreneurs will not exit their operational role at the company at the exit. Now, they may do within some period of time, but these two things are not two sides of one coin. They're unrelated. Not wanting to exit and wanting to build a successful company for the long term are not mutually exclusive. And the last one, my last fifth most favorite fail response is my favorite. The entrepreneur responds with, Steve Jobs said you should not start a company with an exit strategy, which I really enjoy, because I feel like the entrepreneur always says this with the expression like, this is the conversation ending answer because Steve Jobs said, and therefore it must be correct. Which actually I agree. I understand what Steve Jobs is saying here, but I don't believe he's saying you shouldn't have an exit strategy. What he's trying to say is you shouldn't start a company just to exit. You don't think that you're going to build a startup and flip it and make money. It doesn't work like that. And I find very hard to believe that Jobs started any company without an exit strategy, because he provided his investors with extremely successful exits, pretty much every company that he started. So either he was incredibly lucky, which it's possible, or he thought very carefully about exit strategies. So now, okay, the second next best or next worst fail answer to what's your exit strategy is, now this is a little better. Definitely this is better than the previous list, because in this case, the entrepreneur understands that it's important to exit. So this is a big improvement over previous slides. But when the exit strategy is trade, so the entrepreneur says, our exit strategy is trade sale or IPO. But the only realistic options for exit are trade sale or IPO. So by just saying our exit strategy is either trade sale or IPO, that's the same as no strategy, because that's saying I have two options, I'll do one of the two. And that's not what I consider a strategy. So for exit strategy, we should choose. Are we targeting trade sale or are we targeting IPO? And if we are targeting a trade sale, then the other components of our exit strategy should be, okay, we're targeting, or we're strategizing to be acquired by large regional player in our industry, in our sector. We expect this is going to happen somewhere within the next 5 to 7 years. We believe that the value of the company at exit will be X, around X, and then we'll explain how we got that number. And here are some examples of comparable transactions that have taken place over the last few years in our market. So to me, that's a pretty robust trade sale exit strategy. If my exit strategy is IPO, then okay, we plan to IPO on what exchange? When are we planning to do this listing? What will our firm value, what's our projected firm value at IPO, and how did we arrive at that number? So it's okay to choose one or the, you need to choose one or the other and then explain a little more detail how you're going to do it. Now, okay, I know some people are thinking, but actually, or I expect some people are thinking, the market for exit market for startups can be very volatile, and who knows what's going to happen when we're ready, by the time we're ready to exit, and many things can change, internal and external. Exogenous factors can play a big role. So how can we say trade sale now when we may do IPO? And this is exactly correct. Just having a exit strategy doesn't mean it won't change, and it definitely can change. You know, we could be targeting trade sale and later pivot to IPO. We could be targeting IPO and pivot to trade sale. We could target trade sale, pivot to IPO, and then pivot back to trade sale. It can definitely happen, and it likely will happen, depending on what are the opportunities that we're presented with. So don't worry about that. Just pick a strategy now that makes sense. Make sure that you include it, and then you stay open, understand what's happening in markets, and adjust as appropriate. So I mentioned also the other previous slides that talk about why no exit means no ROI. Now, just to summarize again, why no exit strategy means no valuation. So startups create value for investors through exits, and therefore the primary valuation method for startup companies, which is the VC method, reflects the real value to investors, and it is based on exit strategy. And here's how it works. So I mentioned exit valuation determines current valuation, and this is how the VC method specifically relates exit valuation to current valuation. I showed the first formula already. VC return equal exit valuation divided by current valuation. So we'll use 30x as required return at seed stage. We will now adjust for dilution because that's important for this formula to really work. In this case, because we're using an example from seed stage, the dilution adjustment will be 50%. This means current valuation equals exit valuation divided by 60. And where do we get that number? 20% IRR for 10 years, which is the typical requirement return requirement by investors in VC funds, means the VC fund has to deliver 6x multiple, 6x gross multiple over 10 years. They have to do this while on average only 20% of their investments are actually exiting at more than one time the investment. And for 20% to grow to 600%, this means that we must increase by 30x post dilution successful investments. So how do we calculate the exit valuation? We do a 5-year revenue this is for a typical startup. So how do we calculate the exit valuation? Do a 5-year revenue forecast, take year 5 revenue, multiply that by a sector revenue multiple for acquisition, assuming it's a trade sale, or you can do for, if it's IPO, you can look at the trading multiples, trading revenue multiples. Do this while avoiding outliers. So another very common mistake that I see by entrepreneurs when they do the first couple of steps. So they have the 5-year revenue forecast, they take their year 5 revenue, and for the sector revenue multiple, they use the highest possible multiple they can find. So let's say there was recent news article from some acquisition startup was acquired in a trade sale, and the revenue multiple was 100x. Let's say the sector average is 7x, or let's say 5x, but there was one deal at 100x. So they'll use 100x for their revenue multiple. Their argument will be, you know, somebody got 100x, so we should get 100x. We're just as good as them. But which I think it's fair argument to make. But in order for revenue multiple valuations to work, they need to be based on sector averages, because that's the reason that they're actually considered reasonable. If you just pick any number, especially, you know, pick any large number, then the negotiation leverage that you get from using sector average goes away. Now, I think it's okay if you look at, for example, let's say instead of the mean, you look at the top quartile. So if you can get those numbers, okay, top quartile or even top 10% revenue multipliers look like this, and we believe we're going to be in the top 10%. I think that's a more reasonable case to make than we're going to be, you know, 6 standard deviation from the mean with our revenue multiplier. And you can see this is an example of how this works. When you look at the typical valuations in different exit strategies, and then look at the implied current valuations. So you can see how the current, you know, for the same company, you know, assume this is a Thai company with, you know, let's say looking at 6 different exit options. So if the exit option is valuation is a listing on MAI, then the current valuation is $1 million. This is in USD. If the exit strategy is Nasdaq IPO, then current valuation is $7 million. So that's 700% difference in current valuation based on exit strategy. And you can even see it's almost double if they're going to do a trade sale versus MAI listing. Now, not picking out MAI here, and this is 2019 data, so it's possible MAI numbers have shifted and will continue to grow in the future. But this is the type of analysis that shows the very clear and important relationship between exit valuation and current valuation. And okay, so now I want to talk about some exit strategy myths versus reality. This is the exit strategy, you know, #1 myth. Now, what do I mean? This is, I'm sure you can recognize, this is Mark Zuckerberg and Facebook ringing the bell on their Nasdaq IPO. And definitely, you know, everybody's dream, I think every entrepreneur's dream around the world today is to do an IPO on New York Stock Exchange or Nasdaq, or a dual listing on Nasdaq and Stock Exchange of Thailand if they're a Thai entrepreneur. So it's okay. It's okay to have a dream. And I think that is a very inspiring dream for a lot of entrepreneurs. But if you remember, actually, Facebook IPO was a mess, and I think resulted in even some very bad feedback about the IPO process itself. But setting that aside, definitely the IPO on Nasdaq, ring the bell on New York Stock Exchange. I think a lot of entrepreneurs, you know, dream about that even before they start their company. But the reality is, IPO exits are a very, very small percentage of total venture funded startup exits, and which means the probability that you're going to exit in a trade sale is 10 times more than the probability you're going to enter in an exit in an IPO. For every startup that IPOs, 10 startups exit in trade sales. So the other way I put that, 90% of venture funded exits are trade sales. And this is a chart, this is also using 2019 data, and this is from the US market. The US venture market, I mean, the US has the most IPOs of any country in the world. So if you think about, this is for, US and startups that are going to the US for IPO or for exit, even there, a very, very small percentage exit in IPOs. You can see here it was fewer than 100 IPOs, and there were more than 700 trade sales. So that's a huge difference. And in Southeast Asia, it's even more, because there's even fewer IPOs in Southeast Asia than there are in US, and there are many fewer IPOs of high-tech startups. So, or high-tech startup IPOs. And this is looking at median valuation of different types of exits. So definitely IPO exits, the firm valuation can be much higher in IPO exits, although there are some huge trade sales now. I mean, there are trade sales in the billions and tens of billions of dollars, but still the average valuation of the company in an IPO will be significantly higher than the average value of a company in a trade sale. But here you can see trade sale average valuation or median valuation was 100 million in the US in 2019, which is not too bad. 100 million in the US it's 3 billion Thai baht. And when we look at the big IPOs, most of the big IPO valuations are in the US. So now you can see our own partner here, SET, is very healthy, though. There are quite, the median valuation of IPO exits in SET is in this year anyway, 2019, well above UK and Hong Kong. But still, when you look at the really big exits for they're going to be on US markets. And then when you get down to the secondary boards, so SGX here is MAI. So when you, is Catalyst. So when you look at Catalyst and MAI, the average firm value in these exits is very low, and it's well below trade sale, well below average trade sale valuations from the same data set. Trade sale exits are also much faster on average than IPO. So from first to post-seed funding round to exit in the M&A, 5 years, IPO almost 7 years. And if we look at 2020 now, yeah, obviously 2020 wasn't a great year, but if we look at the top 20 IPOs in Southeast Asia in 2020, there was only one tech company, and this was in Singapore. And if you look at some of the other, some of the other IPOs, they're very traditional businesses. I mean, right here in Thailand, we have huge IPO, Central Retail, SCG Packaging, Sriton Gloves. So Thailand and SET very well represented in top IPOs. Again, we're really proud to be working with SET. You can see they're, why I said they're the leading stock exchange in Southeast Asia based on the size of IPOs, but it's still a very small market for tech IPOs now and startup IPOs. Now, can this change? Definitely this can change. Is it will IPOs become more prevalent over the next 5 to 10 years, which is the relevant time frame, I'm assuming, for you when you're thinking about exiting your startup? I bet they will. But if we, again, even when we go back to look at US markets, which are the most mature venture funded exit markets in the world, trade sales still 90% of venture funded exits. And I just did a very quick search for trade sales. M&A is the other side of trade sales. So the M&A is from the acquiring side, trade sale is from the selling side. And you can see we had, and this is not like deep research. This was just a quick search, transaction search that I did. But I quickly found in 2020 117 trade sales, and you can see some of these trade sales were also very substantial size. So we have 1.7, 1.2 billion, half a billion, 250 million. These are all in USD. So there's some pretty big trade sales in 2020 in Southeast Asia, and the number is hugely greater. I mean, again, this is not clean data, so we get some of these are not tech companies, but even if only half are tech companies, we're still looking at 60 trade sales versus one major IPO that I can find. So exit strategy, which is best? Now, I think when you're looking at IPO, the exchange makes a big difference. So if these are two startups that did get to IPO exit. So there are IPO exits. Don't think that for a minute that what I'm saying is there are no IPO exits, because that would be ridiculous. There are IPO exits for venture funded startups, and including for Southeast Asia startups. I have two examples here. You probably know both these companies. Both are Singapore companies. Razer did an IPO on Hong Kong Exchange, and SEA, which used to be called Garena, did an IPO on New York Stock Exchange. And you can see the difference. Look at what SEA performance. This is SEA since IPO. Their current valuation is down 25% from their IPO. So they have lost significant value since IPO. SEA is increased exponentially since their IPO. So you look at their IPO around, I think, $20, and they're almost $300 a share now. And you look at the firm value, they're at 140 billion versus Razer's 27 billion. I think Razer's market cap is down significantly since IPO. So, okay, so that's an example. And when we talk about which is best, so you can't say necessarily, one is better than the other, but we can look at the pluses and minuses of the fundamental exit strategy. So comparing trade sale exit strategy to IPO on a regional exchange and IPO on a major exchange. So what is the likelihood of success? Relative likelihood of its trade sale exit strategy is high, meaning most startups that exit in trade sale by a huge margin. The likelihood of achieving a regional exchange IPO is low compared to trade sale, and the likelihood of achieving IPO on a major exchange like Nasdaq or New York Stock Exchange is vanishingly low, so extremely low. So if we think about likelihood of success, trade sale strategy is much higher, ranks much higher. I call winner. So how much will founders and investors get paid? Trade sale will be medium. IPO regional exchange will be low generally, and IPO major exchange will be high. So now there's two ways to look at this. So you can look at if you make it to an IPO on a major exchange, you're definitely going to see the biggest your average firm value, and therefore average proceeds for investors going to be the highest. But if you think about the expected value, meaning we multiply the value by the likelihood of success, trade sale is going to win. So on an absolute level, IPO major exchange here wins, but IPO regional exchange in many cases will be lower firm value than trade sale, especially you're on a second board. I would consider, SET is like major exchange here, or in between major and regional exchange. So, but if you're on a secondary board, the value is definitely going to be lower than average value in a trade sale. Okay, the next thing we want to think about is, when do you get paid? It's meaning, when do investors and founders get paid? Now, this is something that I think a lot of entrepreneurs don't consider when they look at their exit strategy. So in a trade sale, the way that it typically works, you get paid upfront. So actually, investors typically will be able to sell all their shares at the closing. So they'll sell 100% of their shares. Founding shareholders or founder shareholders will most likely not get to sell all of their shares in a at the closing, because they will usually have some sort of earnout. But in a well negotiated trade sale, founders should expect to get at least 50% upfront, and the remaining 50% they could get in 2 to 3 years, depending on what's the negotiated earnout. So you're going to get paid. You're going to get it if you are doing a good deal. You'll get at least half paid now, and the rest you're pretty sure to get paid within the next 2 to 3 years. IPO, regional exchange, you're going to get paid later, and maybe never. Why? At a IPO major or regional exchange, founders typically, almost every exchange, founders get to sell zero at the IPO because they're locked up, and the lockup period can range from 6 months to 2 years. So this means you typically at the listing, founders receive zero. They have shares in publicly traded company, but they're not able to sell those shares for some period of time, generally between 6 and 12 months, 6 and 24 months. And second problem that you don't think about, you only find out later on regional exchanges, is lack of secondary market liquidity. So especially if you're a mid-cap or relatively small cap stock on a public exchange, it's very likely that it's very often the case, there's almost no trading volume in your shares on typical days. So if you're not covered by major equity analysts, if institutional buyers don't want to buy your shares, you may have very hard time actually selling shares even if once your lockup ends. And the next problem that you're going to have is even if there is some demand for the shares, in most exchanges, when founders sell shares, they have to announce that publicly. And as soon as founders start to sell shares, the share price goes down because other investors wonder, why is the CEO selling? Why are the founders selling? So as you sell, you depress the price, and you're going to get less and less. And of course, you're also hurting your other shareholders who are wondering why you're depressing the share price. So lack of liquidity and bad perception when founders sell make it very difficult for you to liquidate a large shareholding, especially on a regional or smaller exchange. IPO major exchange, you can still have the same liquidity problem, but presumably you will be able to sell at least some of your holdings at some time. So winner here, when you get paid, clear winner is trade sale. What happens to founders after exit? So in a trade sale, typically founders have an earnout period that I mentioned where they're required to stay with the acquiring company for some period of time, usually 2 to 3 years, at which point they're often free to leave. A lot of founders do leave after the earnout period to go do something else, do a new startup, but they may choose to stay. In real life, a lot of founders don't like to stay too long after earnout in a trade sale because they want to run their own company. That's why they become entrepreneurs. If you do an IPO on a regional or major exchange, unless some unusual circumstances, you typically can stay as long as you want or as long as the company wants you. So winner is IPO. So I think on 2 out of the 4 dimensions, trade sale is clear winner. One may be tied if we look at expected value, but then maximum value for how much, and then IPO, the clear winner on what happens to founders after exit. Okay, so that's all I want to talk about in my material tonight. And happy to answer your questions about exit strategy, why it's important, and happy to argue about anything that I said or defend anything that I said, or answer any challenging questions that you might have.
Okay, Douglas.
You can type your messages in your questions in the chat.
ค่ะ สำหรับผู้เข้าร่วมสัมมนาทุกท่านนะคะถ้ามีคำถามสงสัยหรือว่าอยากจะถกเถียงกับคุณดักลาสนะคะเรื่อง exit strategy แล้วก็มุมมองที่คุณดักลาสได้นำเสนอไปนะคะโดยเฉพาะอย่างยิ่งข้อสรุปเมื่อกี้นะคะให้สามารถส่งคำถามมาได้เลยค่ะเดี๋ยวอีกสักครู่ค่ะดิฉันจะแสดงคำถามที่ทุกท่านได้ส่งเข้ามาให้คุณดักลาสตอบนะคะสำหรับในวันนี้ค่ะดิฉันก็ขออนุญาตสรุปใจความสำคัญสั้นๆนิดหนึ่งนะคะexit strategy ค่ะแน่นอนค่ะมีความเชื่อมโยงแล้วก็เกี่ยวเนื่องกับvaluation นะคะโดยวิธี VC method จากที่คุณดักลาสได้สรุปให้ฟังในช่วงต้นนะคะแล้วก็แน่นอนคุณดักลาสก็บอกว่า IPO เนี่ยเป็นความฝันของสตาร์ทอัพนะคะผู้ประกอบการทุกท่านนะคะแต่ในความเป็นจริงแล้วนะคะเทรดเซลก็เรียกได้ว่าเป็นวิธีการ exit ที่กินจำนวนเรียกว่ามีแชร์ประมาณมากกว่า 90% ขึ้นไปนะคะซึ่งพอเราได้ดูสไลด์ที่คุณดักลาสสรุปแล้วก็เปรียบเทียบให้ฟังเนี่ยก็ได้เห็นภาพชัดขึ้นนะคะว่าอ๋อพอมีการจัดเรื่องของ M&A และ Trade Sale เนี่ยก็คือว่า Founder และ Investor เนี่ยก็จะได้รับเงินเลยนะคะแล้วก็ถ้าเป็นในส่วนของ IPO เนี่ย Founder ก็อาจจะเจอในเรื่องของ Lockup Period นะคะทำให้อาจจะยังไม่สามารถขายหุ้นได้เมื่อตอน IPO นะคะนอกจากนี้ก็อาจจะมีประเด็นบางเรื่องในแง่ของ Liquidity นะคะโดยเฉพาะอย่างยิ่งถ้าเป็นในส่วนของตลาดรองในส่วนของตลาดรองหรือการซื้อขายถ้าสมมุติในกรณีที่หุ้นเราเนี่ยยังแบบไม่ได้เป็นท็อปของตลาดนะคะเอาละค่ะตอนนี้นะคะเรามีคำถามที่ผู้ประกอบการทุกท่านนะคะได้กรุณาพิมพ์เข้ามาใน Q&A box แต่แนนขออนุญาตค่ะส่งคำถามให้คุณดักลาสเป็นคำถามที่มาจากทุกท่านตอนที่ลงทะเบียนเข้าร่วมสัมมนานะคะโอเค Douglas this is the question coming from the registration period and the first one for you is listing in stock market is a way to go for a good exit in Thailand.
Oh, I just saw 3 questions in the chat box, in the
Yes,
Q&A box.
Definitely, we'll get to them. So there are 4 these are pre-submitted questions. So I'll show them all, and then you can pick and choose which one you would like to address. Okay, can you give some example of startup being acquired pre-revenue? What strategy do they use to get spotted by the acquirer?
Oh, I see. Oh, this is on the slide, right?
Yes, yes.
So, okay. Is listing in stock market is a way to go for good exit in Thailand. So definitely, I think as I mentioned in the talk, the 2 options are trade sale and IPO. And if you're going to do, if you're going to do IPO, Thai market is a good market to IPO relative to some other markets because as you can see from my presentation, SET is the leading stock exchange in Southeast Asia. And there is, I think, more appetite for high growth companies in Thai stock market than, for example, in Singapore or some of the other regional exchanges. So I think you can also, if you list on the main board in SET, you can definitely get a significant valuation, which can generate a great return for your investors. So, and there is quite a bit of trading on SET. So I think some of the secondary market problems that I talked about in other regional exchanges are likely to be much less prevalent in SET. So I think definitely listing in a stock market is a reasonable exit strategy, and especially in Thailand. However, I believe trade sale exit strategy is much more likely to succeed, even in Thailand, because although SET can be a good market to list, most startups, many more startups will exit in trade sales than in listings. And the listing process is also very arduous. So it takes up to 3 years to prepare for listing. Trade sale can close in 6 months. So, and some trade sales even faster. So I think there are pluses and minuses to both types of exit, which I showed in the last slide. I have a preference for trade sale because I like that they're more realistic, meaning many more startups exit in trade sales. I like that you get paid up front, and I think that therefore the expected value is higher both for investors and for startup. Can I give example of startups being acquired pre-revenue? What strategy did they use to get spotted by the acquirer? So definitely some startups get acquired pre-revenue. And in some sectors, like for example, in medical device, in drug development, many drug development and medical device startups get acquired pre-revenue. In fact, in the US market, it's more as common for medical device startups to get acquired pre-revenue as post-revenue. Now, in something like drug development and medical device, companies get acquired pre-revenue because they have either completed clinical trials or they have got patents for their IP, which are considered both extremely valuable and also very strong leading indicators of post-acquisition value in those companies. So I think in certain sectors, pre-revenue acquisitions are pretty common. In other sectors, in most other sectors, they're quite rare. And in most other sectors, if a company is being acquired pre-revenue, not based on IP and not based on regulatory approval, then the acquisition is will usually be relatively small. So I would say if you're not doing drug development or medical device, I would not target a pre-revenue acquisition as my primary exit strategy. And especially in Southeast Asia versus US, there are many more pre-revenue acquisitions in the US markets than in Southeast Asia markets, because there are more investors that are more acquirers that are willing to buy pre-revenue companies, and there are more investors that are willing to make investments into pre-revenue companies. Before companies get to exit, they will generally raise several rounds of funding, and in order to raise rounds of funding pre-revenue, you have to be in markets where investors are willing to make investments in pre-revenue companies. Because many Southeast Asia investors are not interested or not willing to invest in pre-revenue companies, it's much harder to get to pre-revenue exits in Southeast Asia. So third question, since things could change over time, can we be open for both exits through M&A and IPO? And yeah, I hope I made this point clearly, is that we definitely should always be open to exit through M&A or IPO. And I tried to differentiate between having a strategy to focus on one from not being open to both. So we always want to be open to opportunity. If let's say we're preparing for an IPO, let's say we have IPO exit strategy from day one, we're preparing for IPO, we get a great acquisition offer. What should we do? We should consider the great acquisition offer, because that's new information. So we always need to be listening to the market. We always need to be open to opportunity. So strategy is not dogma. Strategy is not carved in stone. Strategy adjusts with opportunity. So have an exit strategy, but also be open to opportunity. How is deep tech startup go in the early stage with investors? So this is not exactly a question about exit strategy, but happy to answer that. I think deep tech, it's a very hot sector in venture investing, and it is also a hot sector in Southeast Asia and Thailand specifically. Even in our own Expara fund in Thailand, we have made several deep tech investments and considering more deep tech investments. So I think it's, and we do early stage. So I think it is a good time to be a deep tech entrepreneur in Southeast Asia and specifically Thailand, and raising money now. Okay, so now moving to the Q&A box. What about pre-revenue tech sales? Does that happen often? What kind of go-to-market strategy should you adopt to maximize chance of that? So I think this is very similar to the question that I answered on the PowerPoint slide. There are some sectors where pre-revenue trade sales happen. They're usually happen in very specific sectors. And they usually happen in sectors where go-to-market is a lot less important. So with drug development or medical device development, although some medical device companies do go to market, in that case, they wouldn't be pre-revenue. You know, once you go to market, then you're selling the product, so no longer pre-revenue. So I would say I wouldn't focus too much on pre-revenue exit unless you're in one of the sectors where those are prevalent. And if that's the case, then you also might want to think about what's the right market. So if I'm a drug development startup or a medical device startup targeting a pre-revenue exit, I might want to look at, for example, the US market where those types of exits are more common than in Southeast Asia. So next question. In my opinion, and also from my good friend, so in my opinion, why do you think Thai startups aim for IPO? I think that's a great question, but I don't think it's just Thai startups. I think entrepreneurs in general aim for IPO or dream of IPO. I think very few entrepreneurs dream of trade sale. They dream of IPO because, I like to put it this way. When I talk to entrepreneurs about this, I ask them, do you want to be famous or do you want to be rich? If you want to be famous, do IPO. If you want to be rich, do a trade sale. So I think a lot of people want to be famous, including a lot of entrepreneurs. So they have the image of themselves standing up there, ringing that bell, on the cover of the Forbes magazine or in the financial press. They're now now they're CEO of public company. So CEO of public company, it's something special, and it's a culmination of a dream. So I think it's a good thing, and it's very motivating. At some point, the entrepreneur might want to think about, is it that the goal you want to go for? And I'm not going to discourage anybody who truly believes that that's what they want to do, but then you have to figure out, how am I really going to do that? Because it's very rare to succeed in that path. Why do you end up getting lower returns through regional IPO versus trade sale? So, I mean, I can't say you definitely end up getting lower returns, but what I can say is in the analysis that we've done of the valuations of the average valuations of companies listing on regional exchanges versus the average valuations of trade sales, the average trade sale valuations are higher. Now, why is that the case? I think has to do with the appetite of the investors in those markets and the amount of funding in those markets. So next question, do you consider PTTOR listing a success? Can you please share your thoughts? So I'm gonna invoke a rule on this question, which is I try not to answer questions that I'm not expert in or that I don't have any special insight in. So I love PTT, and I think they're a great company, and I've worked with them in the past, and I have a lot of respect for what they do. And but I'm not an expert on whether their listing is a success or not. I don't have any special insight into that. I believe I have special insight into things relating to startup and venture capital, and exit strategies is a subset of that. So I'm going to pass on that question because I like to talk only about things that I think I know something about more than what I read in the news. But it's a good question. I'm sure somebody else happy to share about that. Okay, next question. Regarding the alternative ways to go public, reverse merger, what are upside and downside compared to traditional IPOs? Yeah, so there are other ways to do listings besides a straightforward IPO. There's reverse mergers, and there are now these special purpose vehicles that are blind vehicles set up to buy, that set up a public shell to buy a company to do a listing. I think these are all they're interesting variations on IPO. I think they're still even more rare than the standard IPOs. So they may grow in importance over the next 5 to 10 years. It's something we can look at. I think traditionally, reverse merger, something like a reverse merger, or the backdoor listing, you're going to see even less liquidity than you would in a traditional IPO. So at this point, I would say if you're going to go IPO, I would look at traditional IPO first. Next question, in VC perception, if VC asked about exit strategies to a startup, what is your expectation for the answer? And if impacted for a startup to get funds, should we say to IPO? So I can't speak for all VCs. I can say what I think and also what I believe a lot of VCs think. If they ask you what's your exit strategy, I wouldn't say there's a right or wrong answer. I think they expect you to have an answer. So answer exit strategy is trade sale, and here are the details like I talked about in the previous slide, or our exit strategy is IPO. Here's the details, and then also why. So why do we want to exit in trade sale, or why do we want to exit in IPO? So I don't think the specific answer is as important as the understanding demonstrated, having an answer, and the understanding demonstrated by your answer. Next question, will you not invest in a startup if its exit strategy is IPO? I definitely will. We have already invested in startups who have exit strategy IPO. So we don't reject startups because they have exit strategies IPO. If the startup targets IPO as exit strategy, that's fine, as long as they understand what that means and are able to make their case for why IPO is the right exit strategy for them. So although I tend to prefer trade sale because I think it's more realistic, and we're in such a difficult game anyway. It's so hard to win this game. Why put the extra pressure on yourself? But it's your company. If you're serious about IPO, so I would distinguish between the IPO dream and serious about IPO. So you're serious about IPO, you're going to list on SET. You're going to list on SET in 5 years. You're going to start your the process of your listing 2 years from now. You know exactly how that works, and you're planning to do it. You have examples of other companies like yours that have already listed or closed a listing on SET. You have idea what your firm value is going to be at your IPO, and you have justification for that firm value. Then great, that's a very solid strategy for a Thai startup. So key here is have a carefully thought through strategy that makes sense, and it's not something like I want to stay with the company forever. If that can be one part of why you want to do it, but as long as you can make your case, then that's great. Next question. What do you think if the startup acquires a competitor and builds traction to IPO or trade sale? So definitely growing through acquisition is a valid strategy for startups. So this depends a lot on the startup, the market that it's in, how they're using the acquisition. So if they're using the acquisition to, for example, expand into new regional markets where they can expand faster and more effectively through acquisition than they could organically, then this can definitely be a good strategy for the startup. I know there's some strategies of rolling up lots of different companies to try to package into IPO. I don't believe in that strategy, but startup acquiring, doing strategic acquisitions as part of its growth strategy is very reasonable and normal. Next question. What's the definition of deep tech startup? Yeah, this is a great question because everybody talks, you hear a lot about deep tech, but it's not necessarily that clear what deep tech is. And I think it's one of those things where there isn't one great definition of what's deep tech. And my personal view, deep tech are startups that are basically driven by research-based intellectual property. So real IP and technology innovation rather than business model innovation. So I think that's the way I would distinguish. Deep tech startup is a startup that has real proprietary technology, intellectual property, and is not basing their value proposition on business model innovation. Why does entrepreneurs always aim at Nasdaq for IPO? Are there any other alternative with nearly the same or even more investment upside potential? So I think the reason that a lot of entrepreneurs focus on Nasdaq or New York Stock Exchange is because those are the stock exchanges that have the most high tech or most startup IPOs every year or have had over the last 20 years and the biggest IPOs. So if you want to think about some of the criteria that I looked at before, how likely is it? So if you're going to get to an IPO, I mean, there's more IPOs on Nasdaq and New York Stock Exchange for high-tech startups or for startups than any other exchanges. So although it's still low probability, it's higher than on other exchanges. How much are you going to get paid? The biggest, there are other exchanges with big IPOs, but the average size of IPOs on Nasdaq and New York Stock Exchange are the highest, have been the highest in the world. When will you get paid? There's a lot of secondary market liquidity in those exchanges. So I think those two exchanges rank very highly on the criteria that we discussed in the last slide when considering different exit strategies. So the next question is, can a trade sale be an open offering to many buyers, sell like auction? So there are different processes for trade sale. So there are some trade sales that are conducted in some form of auction. This happens sometimes. There are a lot of trade sales that are one-on-one. So where the startup is doing unilateral negotiation with one buyer or maybe two buyers, and then ultimately they choose one. But definitely there are some more auction-like trade sales. These are often structured by investment banks. So if the startup engages an investment bank to try to help with the exit, with the M&A or with the trade sale, it's possible that they might organize some sort of auction-like structure around the sale. How do you choose, so the next question, how do you choose between listing in a local exchange versus foreign one? Say Chinese tech firm goes to get listed in US market. What are your considerations besides higher industry average PE ratio? So I think actually the Chinese exchanges have also been hosting more startup IPOs over the last few years. So if you're a China-based or Chinese-based startup, you might consider China-based exchanges as a possible alternative to US. I think I'm not sure I would consider China-based exchanges major exchanges rather than regional exchanges. To choose between different exchanges. So in general, where should I IPO? So I think you're going to want to IPO where you can get the best valuation for your startup and where you can get the most secondary market liquidity for your startup. So where you can raise the most money at the highest valuation and then get the most secondary market liquidity. So I think that's going to be, those are the important considerations that you're going to want to look at when you choose which exchange to try to IPO on or to IPO on. Okay, I think I handled all the open questions in the Q&A. Happy to take any more questions if if people are not too tired.
Okay, in the meantime, Douglas, why don't we, I would really like to ask you to leave like 1, 2, 3 key points for the exit strategies in case the audience is like run out of questions or they are looking forward to hearing like your final tips, like top 3 golden rules, something like this?
So most important takeaways on exit strategy. So I think first is have an exit strategy. Never say that you don't have an exit strategy. I'm pretty sure everybody's going to remember that. And then pick an exit strategy to focus on, either trade sale or IPO, and be able to, and then third one is pick an exit strategy and be able to explain why you chose that. And then last one is be flexible in the exit strategy, recognize that things might change over the lifetime of the company. So have an exit strategy, know what it is and be able to explain it, and recognize that you need to be flexible as the company grows.
Okay, thank you so much. ตอนนี้นะคะเข้าใจว่าทุกท่านก็อาจจะไม่มีคำถามอะไรเพิ่มเติมนะคะเพราะฉะนั้นตอนนี้นันขออนุญาตเข้าสู่ช่วงท้ายของการสัมมนาเดี๋ยวนะคะมีมาเพิ่มไหมone more question อย่าเพิ่งทิ้งกันไปนะคะทุกท่านนะคะช่วงท้ายนะคะแนนจะขออนุญาตรบกวนให้ช่วยกรุณาตอบแบบสอบถามและแนนก็จะทำการจัดส่งkey takeaway นะคะหรือว่าตัว material ของวันนี้ให้นะคะ one more question Douglas
how to be a great target for trade sale. Which company to aim for? I think to be the great target for trade sale is to become number one in your product category in your market. The companies that usually get acquired are companies who are the number one company in their product category in their market. So that your strategy should be get to the number one spot and stay there until you either list or get acquired. Which company to aim for? I mean, I guess that means acquiring company. So which acquiring company to aim for is going to be dependent on your company. So it's going to be the companies in your sector, in your market, who will, I mean, this is a little actually pretty important question, but you're going to want to look at who's a good acquirer for you, but remember when in terms of the economic deal, but once you get acquired, you're going to have to work at that company. So another very important thing to think about is the fit between you and the acquiring company. Because you don't want to sell your startup and then go through 3 years of torture, working in a company that you're miserable at. So you have to be acquired by a company that you feel is going to do justice for the legacy of your company, which will then be part of the acquiring company, and also that you're going to be, reasonably happy to work at for the next 2 to 3 years while you're doing your earnout.
เอาละค่ะมีคำถามอะไรเพิ่มเติมไหมคะถ้าไม่มีคำถามอะไรเพิ่มเติมนะคะหรือว่าถ้าตอนนี้ค่ะมีคำถามอะไรเพิ่มเติมก็สามารถส่งเข้ามาได้นะคะในช่วงโค้งสุดท้ายค่ะเอาละค่ะสำหรับในเดือนหน้านะคะเดือนมีนานะคะวันที่17ค่ะเราก็จะมาพบกันนะคะกับซีรีส์ Common Issues in Early Stage Fundraising โดยในครั้งต่อไปนะคะเราจะมาพูดกันถึงเรื่องCVC นะคะ How to striking a win-win deal with CVC เลือก CVC อย่างไรให้ win-win นะคะก็หลายๆท่านคงจะคุ้นเคยอยู่แล้วว่า VC กับ CVC นั้นมีความแตกต่างกันอย่างไรนะคะทีนี้ค่ะก็จะให้คุณดักลาสมาเจาะลึกให้ฟังนะคะว่าในเรื่องของ terms and condition expectation นะคะจะต้องมีตรงไหนที่ pay attention เป็นพิเศษแล้วโค้งสุดท้ายจริงๆค่ะมีเข้ามาเพิ่มเติม2คำถามนะคะ Douglas there are 2 more questions in the Q&A box please kindly address them and then we'll do the official closing
Okay, hang on. But wait, the 2 more questions were thank you for today. I learned a lot, and thank you, Douglas. And I would like to say in my closing, you're most welcome, but thank you everybody for joining us. And and our great hosts and partners, SET and YBI. We're really honored to be part of the SET series and to thank everybody for joining us and for all your great questions and kind attention on this Wednesday evening. So look forward to seeing you in the upcoming events.
ค่ะเอาละค่ะแล้วรบกวนนะคะขออนุญาตรบกวนทุกท่านนะคะช่วยกรุณากรอกแบบสอบถามให้แนนนะคะอย่าเพิ่งทิ้งกันไปไหนอย่าเพิ่งรีบกดปุ่ม leave the meeting นะคะช่วยกรอกแบบสอบถามค่ะให้ฟีดแบ็กนะคะอะไรที่ชอบอะไรที่ไม่ชอบนะคะเราก็จะเอาไปปรับปรุงกันในครั้งต่อๆไปนะคะเอาละค่ะในช่วงนี้นะคะแนนก็อาจจะขออนุญาตให้คุณนักล่าเซบายบายแนนก็จะขออนุญาตเปิดกิจกรรมในครั้งเปิดสกรีนไว้นะคะอีกสักครู่หนึ่งค่ะ Douglas, there is one more really serious question. Be the number one. This is coming from Kun Nattapop. Be the number one in the product category. Does it mean owning the biggest market share in or any other metrics like higher quality due to proprietary technology?
So yeah, that's a great question. Being number one in your product category in the market is means based on dimensions that whatever dimensions are valued by acquirers in your market. So if the companies are acquired or listed based on revenue, then be number one in revenue. If they're acquired or listed based on profitability, be number one in profitability. If they're acquired or listed based on number of users, be have the largest number of users. So I think there's no single answer to that question. It depends on what does the market value companies in your product category, in your sector on? Whatever dimensions they value on, those are the one or ones that you need to be number one in.